Capital gains tax is a tax on the profit you make when you sell something for more than you paid for it. This is usually an investment like stocks or real estate. Imagine you buy a painting for $100 and sell it for $200. You made a $100 profit. The government wants a piece of that profit. That's capital gains tax. Not everything you sell is subject to this tax. Selling your used clothes online, that's usually okay. But if you sell stocks or a rental property, you'll likely owe some taxes. The amount of tax you owe depends on how long you held the asset. Assets held longer are often taxed at lower rates. Capital gains taxes help fund important programs like roads and schools. Understanding capital gains tax is crucial for anyone who invests. It helps you plan your finances and avoid surprises during tax season. Knowing the rules allows you to make informed decisions about buying and selling. The year 2025 brings changes to the capital gains tax rules. These changes aim to make the tax system fairer and simpler. One proposed change is adjusting the income thresholds for tax brackets. Higher incomes might face higher capital gains tax rates. Another change is increasing the holding period for long-term gains. Stay updated on official announcements from tax authorities. The proposed changes to the capital gains tax rules will impact individuals differently. Understanding these impacts can help you prepare for the changes and adjust your investment strategies. For high-income earners, the potential increase in capital gains tax rates could mean paying more taxes on their investment profits. This might require them to reconsider their investment strategies or adjust their financial plans to accommodate the higher tax burden. On the other hand, long-term investors who hold assets for extended periods might benefit from the lower tax rates on long-term capital gains. This could incentivize individuals to adopt a buy and hold strategy, potentially reducing market volatility. However, the potential increase in the holding period for long-term gains might not sit well with all investors. Some investors prefer more flexibility and might be discouraged from selling assets if it means facing higher taxes. Section 4. Preparing for the changes. The key to navigating the new capital gains tax guidelines is to stay informed and plan. Don't wait until the last minute. Start preparing now. First and foremost, stay updated on the official announcements from tax authorities. Reliable sources like the IRS website or financial news outlets can provide accurate and timely information. Next, review your investment portfolio and consider how the potential changes might affect your tax liability. If you anticipate a higher tax burden, explore ways to adjust your portfolio or investment strategy. Consider talking to a financial advisor. They can provide personalized advice based on your financial situation. They can help you understand the implications of the new rules and make informed decisions. Section 5. Staying ahead of the curve. Change is a constant, especially when it comes to taxes. The best way to handle these changes is to be proactive. Staying informed about tax laws is not a one-time task. Make it a habit to check for updates regularly, especially before making any significant investment decisions. Remember, knowledge is power. Understanding the tax implications of your investment decisions allows you to make choices that align with your financial goals. Don't be afraid to seek professional help. A financial advisor can be a valuable resource, providing guidance and support as you navigate the ever-evolving world of taxes and investments.